Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for September 28th, 2020. Please see our disclaimer for important information. In our Market Minutes this week, the S&P 500 declined for the fourth consecutive week last week, though it did end on a high note. We've got some cross currents, obviously heading into the election, and we also have a rise in coronavirus cases to talk about. So basically, the financial markets have been cooling off a little bit over the last month, and we've had a correction in technology stocks, which has kind of spilled over into the broader averages. But basically, we've got the odds of a quick return to a pre-pandemic environment really seem a little far-fetched right now, and it's clear that we're not going to get fiscal stimulus for a while. We may not, we certainly don't have much confidence in getting fiscal stimulus before the election, and we may not even get it before the end of the year. And in fact, it may take a rather unwelcome jolt of some sort, perhaps poor economic data, or some type of bad data to kind of kickstart that process beyond where it is now. But basically, we have rising coronavirus cases around the world. That's presenting an increased market risk. I mentioned the issues related to the doubts surrounding the fiscal package, and it will be hurting the U.S. economy. We know that it's hurting small business. We know that the income levels for lower income cohorts that have depended on that stimulus have been impacted, and we know that we can't get back to pre-pandemic levels without a full reopening, and we're not going to have a full reopening likely until we have a vaccine. And there's a lot of speculation that continues to float around with regard to when that vaccine is going to come. But notwithstanding that, we still have uncertainty increasing in the U.S. Political environment. There's a lot of confusion as far as how the voting system is going to work, and is there going to be a complete victory and clear victory on the part of one party, and when would they concede, and when would we know? And there's a lot of unknowns there. Now we've got puts and takes on the economic data. We'll talk about housing here for a brief minute, but housing is clearly the bright spot in everything, whereas labor is still fairly weak, and we know that the labor displacements have been disproportionately impactful to the lower income cohorts. But we've got kind of mixed results on the corporate earnings outlook. There's a lot of optimism. If you look out on the horizon for next year, I think the market is pricing in a fairly strong recovery in earnings, and I think that is yet to be seen. So we've got almost 3/4 of year-over-year decline in the second quarter earnings coming from sectors that were really hit by the pandemic, and those areas are not going to be recovering very quickly. And again, it probably is leaning on technology and healthcare to drive a lot of these gains, or at least these expected gains in earnings next year. But again, we know that there's a lot of uncertainty around there. But as we talk about the market, we know that overall the momentum behind the economic recovery here is waning. We've got benefits that we saw from reopening parts of the economy earlier, and increased the benefits paid for unemployment and job protections, business assistance. That stuff is kind of taken a back seat now. And like I said, I think it could take some type of a painful market decline, or some type of economic data, unexpected data burst to take to get legislators back to the table to negotiate continuing stimulus. But either way, I think volatility is probably going to continue to be something that we're going to have to pay attention to. But as for last week, the S&P was down 0.6%, the Dow was down 1.7%, NASDAQ was up slightly, and the Russell 2000 encompassing small caps was down 4%. So for the month, S&P is down about 5.8%. So this is September is clearly marking a divergence in trend as far as how the how the equity indexes are doing, because the Dow is down about 4.4%, NASDAQ's down 7.3% for the month, and the Russell 2000 is down 5.5%. International stocks for the month are down about a little bit more than 4%, but if you look year to date, the S&P 500 is still up 2.1%. The Dow, which went back into negative territory, is down now close to 5%. The NASDAQ is still up about 21 to slightly more than 21.5%. International stocks are still down 10%, and bonds are up about 6.8%. So especially longer dated maturities have done real well year to date, even though bonds are kind of mostly flat for the month. High yield took it on the chin over the last month, and they're basically slightly below flat for the year. But if you look in some of these other areas which have received a lot of attention over the last several months, oil, WTI crude was down about 5.5% for the month, down about 34% for the year. Gold actually corrected a little bit more than oil did, was down about almost 6% for the month, but it's still up 22% for the year. And then the dollar index for the month was up about 2.7, but still down about just under 2% for the year, with the 10-year Treasury holding steady at about 0.65%, and 3-month LIBOR holding close to about 0.23%. So we know the Fed is going to keep rates low for longer. I think we've got some increased speculation on inflation, and we've certainly seen a huge spike in investors wanting to purchase inflation protection. That was in our charts of the week segment, which you'll be seeing here fairly soon. But rising inflation, would benefit small caps, which have really taken it on the chin, banks, which have taken it on the chin here lately, energy and industrial stocks, and obviously if you had inflation, that would help gold and Treasury inflation protection, and leveraged loans and convertibles. Leveraged loans are basically mostly flat for the year, so you'd see a little bit of benefit in them. But puts and takes for the market. We have resurgence in infection rates. I think we've got the possibility of negative economic surprises, and and then again, depending on who wins the election, you have this fear, whether it's really founded or not, in having higher corporate tax rates next year. And I think that's, of all the tax rate change rhetoric that's out there, the corporate tax rate change is probably the most likely one to get pushed through in some form or fashion. But that is clearly a fear out there. Now on the flip side, you've got massive policy stimulus, monetary policy, and you've got a Fed backstop there, and negative real rates are going to continue to drive more capital into equities, in my opinion. So that's kind of what's out there. But let's see, just looking at some other things. Coronavirus cases increasing in the U.S. We know some of that's linked to college reopening. The death toll is past 200,000. Europe, we know, is in the middle of I guess the early components of a second wave, and we're getting ready to enter flu season. So remind everyone to get your flu shots. But we've got a huge rise in credit, whether it comes from housing or it comes from high yield. There's a junk bond issuance chart in the charts of the week pack that, I mean, we've already set a record for an annual rate of issuance of junk bonds, which are bonds that are below investment grade, and we topped 2012's number, and we're still going, frankly. So we've got banks that are being a little bit tighter on credit for borrowers, especially for non-credit worthy borrowers, and we know that delinquent loans are beginning to rise appreciably, and 60-day delinquencies are up to about 7.2% of all subprime loans that are outstanding, and so that's a big deal that we need to pay attention to. But I mean, we've got other things going on. Obviously, we've got jobless claims. We know that continuing claims are continuing to drop a little bit, but they're still really, really high. And initial jobless claims are still 4 times higher than where they were before the pandemic. And so layoffs are still coming at a reasonable pace, and it's going to take a long time for us to return to that low unemployment environment, especially the longer it takes for us to completely reopen the economy. Now, businesses seem to be a little bit more positive about the outlook, and what we can see from non-defense capital good spending and orders for non-defense capital goods. They were up in August, and they're actually above where they were at the beginning of the year. So, at least from a business standpoint, we have increased confidence. But it's still, we still have to see sustenance, I guess, if you will, in that area to help offset what could be some shaky ground for consumer spending coming up. But some other things that we know are coming on the horizon. We have a debate on the 29th, which will be a Tuesday. We know that Fridays on October 2nd, the jobs report that we get that day will be the last jobs report before the November 3rd election. And we'll get a GDP number here tomorrow as well. And so, that GDP number will be, I think, in some respects, it'll be noteworthy in the sense that it'll be incredibly high, like upwards of 25 to 30% on an annualized basis. But again, it's almost a throwaway number because we were so weak in the first quarter and the second quarter that that it was only natural to think that you'd have a large swing on the upside in the quarter following the crux of the pandemic. But I think beyond the third quarter, things could really kind of flatten out for a while as our recovery continues to be very uneven and somewhat hard to predict. Again, I think this will also contribute to increased volatility in the markets and in kind of an overall sense over the next several months. But let's see, the dollar I mentioned is a little bit off. I think the prospects of the dollar to fall further, I think, are kind of predicated in basically these growing U.S. macroeconomic offsets and macroeconomic weakness, if you will, and I think that's going to probably keep the dollar weak, as well as would be the case if you had negative real rates like we do now. A couple of the things I'm just going to highlight, that I pulled out of Sandy Leeds' weekly digest here. But interesting thing is pension funds and endowments. I have been shifting away from U.S. stocks, and the most recent reading, which comes to us on June 30th, or came from data generated for quarters ending June 30th, The median public pension fund that had at least $1 billion under management had 46.6% of its portfolio in equities, with just 21.3% allocated to U.S. stocks. And back 7 years ago, they had 52.7% of the portfolio in stocks and 32.1% in U.S. So, I mean, we have just in 7 years, just in kind of a normal allocation sense, U.S. stocks have gone down by 10% as a percent of overall pension and endowment allocations. And, most of that has gone into private equity and hedge funds, which is now up to 13%. So, and this is an area, oddly enough, that, consumers don't really have access to. They're fund to funds and things like that, but, the average investor really doesn't have a lot of access to this. What was I going to? Doesn't really have access to this. Let's see, what else? Let's see, we've got the Congressional Budget Office projects higher debt and lower growth, and the CBO lowered their estimate of average annual economic growth for the next 30 years from 1.9 to 1.6. And keep in mind that from 1990 to 2019, that number was 2.5. So a much less optimistic outlook looking out over the long-term horizon now on the part of the CBO. And then debt as a percent of GDP per Sandy, I think, is expected to hit 195% by 2050, and that's a 45% increase from the Congressional Budget Office's estimate just 1 year ago, which is amazing. Obviously, we've had, increased spending on entitlement programs, higher interest expense down the road, and the outlays related to the pandemic. And also another factor that they are considering is that we have slower labor force growth due to our demographic shifts to older folks. Other news that that caught my eye here, this IPO market. Most of the IPOs that have been, and by the way, this has been a fantastic IPO market. We've had 235 companies go public this year, and that's the most since 2000. But there's, more of these, about 80% of the money raised by IPOs this year was healthcare technology, or what people are calling these blank check companies, or SPACs, which are special purpose acquisition companies that are meant to acquire, basically allow companies to kind of almost do a reverse merger to get into the public markets. In fact, those SPACs account for more than 40% of the money raised in IPOs so far this year. Now, these have been around for a while, but their importance to the market has not been nearly as pronounced as it has been here this year. So just looking around, I think I think that's about. Just looking through the extra notes here, and to say that let's talk about mortgage standards. We already talked about that. Interesting enough, I'm going to pass this along because so many of us have either kids that went through college, preparing to go to college, or in college right now. But researchers estimate, this is in a Wall Street Journal article, that 3,200 more cases per day have occurred because of the reopening of colleges. But interestingly enough, if you go to a publication called College Reaction, which is college students' own thoughts, 51% of students say it was a wrong choice for their college to allow students on campus. 60% of college students say that they're learning less, but yet of those on campus, 50% have gathered with friends without masks. 57% have seen parties in progress, and 12% of college students have attended an on-campus party. Unlike the general demographic, 84% of students say that they would take an FDA-approved COVID-19 vaccine when it's available. And there's a lot of folks, and we've had some charts of the week on this, that there's a growing skepticism on the part of the general adult public on their interest in taking a vaccine as soon as it's available. The other thing, and I'll conclude on this, is it's, as we struggle with this post-COVID environment, and we struggle with this notion of a longer period with lower interest rates, something that pulled out of Business Insider was really interesting, and it was a pretty interesting article, that the yield on the traditional 60-40 U.S. balanced portfolio, that's 60% stocks and 40% fixed income, actually moved down to about 1.4%. And the 120-year average yield on a traditional 60-40 portfolio is about 4.1%. So it's profound that current yield on that type of balanced portfolio, which definitely has a skew towards growth, is like a third of what it has been over a long period of time. And so this is really getting at the root of, some of the challenges that we're going to have in managing to expectations and managing to long-term financial plans going forward, because where are you going to get the yield which is accounted for, a reasonable amount of total portfolio return? So, it's just, I just mentioned that to highlight that, we're going to have to think creatively. We're going to have to really seize opportunities to take yield that doesn't entail a lot of risk, and try to find and emphasize perhaps equities. I think equity yield or dividend yield on stocks is going to become even more important than it has been. And we know that the yield on the S&P 500 now is significantly higher. In fact, almost 2x the yield that you could get on a 10-year U.S. Treasury. So anyway, so I'll go ahead and conclude on that. Obviously there's puts and takes in this week's column. We'll have, at least some jobs data behind us when we gather next time. We'll know how this debate turns out this week. We'll get some more data, and we're going to really kind of try to drill down on what the tea leaves say as we head into the third quarter earnings season, which will pick up in earnest here in about 2 weeks. So until then, hope you have a safe and wonderful week, and we look forward to talking to you again soon. Take care.